You were right, and you still lost money. You called the direction. Bitcoin did exactly what you said it would do. It just did it about 20 minutes after your stop got hit. That is not an analysis problem. That is an entry problem, and it has a specific fix with a specific name and a specific price. Traders call it the optimal trade entry. It is the zone I wait for with my own money instead of chasing a candle that is already run. By the end of this, you will be able to mark it on any Bitcoin chart, and I will show you exactly where it sits right now with real prices from this week. So what is it in plain language? Price does not move in a straight line. It moves in a leg, then it pulls back, then it continues. The optimal trade entry is one specific slice of that pullback, 61.8% to 78.6% of the leg, the deep end of the pullback, not the shallow part where everybody else is comfortable buying. To find it, you need exactly two things, a leg and a ruler. The leg is your dealing range, the low that started the move, the high that ended it. Cut that range in half, and the midpoint is equilibrium. Fair value. Everything above the midpoint is premium. Everything below it is discount. And this is the rule the whole concept hangs on. You buy in discount, you sell in premium. If you are buying above the midpoint of the range, you are paying retail, and somebody with a lot more size than you is very happy to sell it to you. Now the part that actually matters. Why that specific band and not just any pullback? Reason one is stops. A shallow pullback of 20 or 30% leaves almost everyone still sitting in their position. There is nothing down there to fill against. But a deep pullback into the 62 to 79 band does two jobs at once. It runs the stops of everyone who entered early and sloppy, and it drags price back to where real size can actually get filled. So a deep retracement is not the trade failing. A deep retracement is the trade getting built. Reason two is cold arithmetic on your own account. Your stop belongs just beyond the origin of the leg. That part is fixed. So the deeper you enter, the smaller your risk and the further away your target sits. Enter at 30% back, you are risking one to make one. Enter at 70% back, you are risking one to make three or four. Same chart, same direction. The only thing that changed was where you clicked. Here is how to find it on your own chart. 4 steps. 1. Find a clean impulse leg, one decisive move with real volume behind it. If you cannot see the leg at a glance, there is not one. 2. Anchor your retracement tool from the low of the leg to the high of the leg. For a short, flip it, high to low. 3. Mark 3 levels, 61.8, 70.5, 78.6. The band between the outer two is the zone. 4. Wait. That fourth step is the entire skill, and it is the one nobody does. Now, how I actually trade it, because the zone by itself is not a signal, it is a location. I do not blind limit into it. A retracement that keeps going is just a reversal you have not accepted yet. So when price gets there, I want a reason. A rejection wick off the level, a shift in structure back in my direction. Location plus confirmation. Entry goes inside the band. The stop goes beyond the origin of the leg, not one tick inside it, because inside is exactly where they will hunt. First target is the high that ended the leg. Let me put real numbers on this, on Bitcoin, from the last 10 days. On August 3rd, Bitcoin bottomed at 62,300. That candle traded 15,543 in volume, the heaviest day of the entire window. That is your impulse origin. From there, it worked higher for 6 days, all the way up to 65,474 on August 9th. 3,174 points. That is the leg. Cut it in half. Equilibrium is 63,887. Above that is premium. Below it is discount. So where did most people buy? On the 9th. Up at 65,400 after 6 days of grinding higher, everybody comfortable. That is the very top of premium. That is retail price. Then August 10th happened. One daily candle. High 65,391, low 63,806, 13,638 in volume, 1,585 points down in a single day. As I record this, Bitcoin is at 64,060, so the trader who bought the high on the 9th is down 1,414 points and is now praying instead of trading. And where is the optimal trade entry on that leg? 61.8% sits at 63,512. 78.6% sits at 62 now on 979. That is the zone. 63,500 down to 63,000. Price has only retraced 52% so far. It has come back to fair value. It has not come back to discount. So I am not long here. I am flat, watching those two numbers, and I will still need a reason when it gets there. And notice where the point of control sits, the price with the most volume traded in this window, 63,980, right above the zone. Two mistakes now, because I have made both of them. The first one kills the concept completely, measuring the wrong leg. People anchor the tool to whatever swing makes their current position look correct. That is not analysis, that is therapy. Pick your leg before you have an opinion. Second, putting your stop inside the origin of the leg. If your stop sits above the low that started an up leg, it is not protection, it is a target. Quick recap. The leg is your dealing range, low to high. The midpoint is equilibrium. Below it is discount, above it is premium. Buy discount, sell premium, never the other way around. The optimal trade entry is 61.8 to 78.6% of that one leg. It works because that is where the stops are resting and where the risk to reward finally tips in your favor. And it is a location, not a signal. Wait for price to arrive, then wait for a reason. You do not get paid for being right about Bitcoin. You get paid for where you got in. I break down one Bitcoin trap like this every day, and I trade them with my own real money on a live chart, not on a whiteboard. Order blocks, fair value gaps, liquidity sweeps, and kill zones are already up on this channel, and they all plug into this. Subscribe, and I will see you tomorrow. Not financial advice, educational only.